The simplest way to invest your money is to invest your money into the stock market. How can that help you with your taxes? Your portfolio tax rates, if you invest your money in the stock market, look like this. But they only look like this if you understand the difference between this: long-term capital gains, short-term capital gains. And what that means is, in the eyes of the IRS, when you invest your money, now that income that you're earning is called CG, capital gains. But not all investments are traded equally. If you invest your money in the stock market today and then you sell your investment for a big profit in 2 months, you're not going to qualify for these short-term rates. What the IRS is saying is that we want to encourage you to be a long-term investor. And by long-term, they mean at least 1 year, and ideally a year and a day, at the very least. If you invest your money for at least a year and a day, you are now investing for long-term capital gains, which means you qualify for the lower tax rates. If you are trading stocks, you're buying a stock and you're selling it in 6 months, 9 months, even 11 months, that's considered short-term capital gains. And in the IRS's eyes, you are no longer an investor. You just have a job in the stock market, and you are going to pay the earned income tax rates, which are the higher tax rates that you pay when you earn your money from a job. So you do not get to qualify for these tax rates when you follow the short-term capital gain strategy, which is buying a stock and holding it for less than a year. If you own a stock for more than a year and you make a profit, you get to qualify for these long-term capital gains rates. And this is where things also get a little interesting, because if you make some money from the stock market, you have to pay taxes. But if you lose money in the stock market, you have the ability to lower your taxable income if you have a job or if you run a business as well. So let's assume now that you buy a stock, you put $10,000 in there. It doesn't matter if it's $10,000 or $1. It's just an example. You buy the stock for $10,000 and then a few years go by and your investment drops in value to $8,000. So you lose $2,000 of value. Now, you only make money or lose money if you sell, but in this instance, let's assume that you actually sell the stock 2 years later. So now we're talking about long-term capital gains. You sell the stock 2 years later and you lose that $2,000. Well, according to the IRS, you can take some of this loss, some of this $2,000 loss, and use it to lower your taxable income. So if you make $50,000 a year, you will have the ability to reduce your taxable income by some of this, which is kind of nice, because if you take this $2,000 and you blow it and lose it on something stupid like a vacation or a car or whatever you lose it on, you don't get to deduct that from your income. Here, because you lost that money in your investment, you do get to reduce your taxable income some. But now let's take it one step further. Real estate has some of the most powerful tax deductions and write-offs that our tax code has to offer. And these are things that really anybody can use, assuming that you are investing in real estate. I'm not talking about buying a house to live in, but renting properties out to other people. And yes, this could be you going out and buying a property and renting it out, or it could also be you going out and buying a duplex or triplex or 4-unit property to live in yourself that you also rent out to other people. There's a lot of ways to hack real estate, even if you don't have a ton of money to start investing in real estate. I have videos on my channel where I go over that. I'm not going to highlight that in this video, but let's assume you go and buy this single family house for $250,000, which, yes, these types of properties do exist if you look maybe outside of where you're living. You buy this property for $250,000, and let's assume that the value of this land is $50,000 and the value of the actual property is $200,000. So $250,000 for the land and the building, and then you rent this property out for $2,500 a month or $30,000 a year of rental income. Pretty nice. But all of this income is not yours. You have to pay for your expenses. You have to pay for your property taxes, your insurance, your maintenance costs. You have to pay for the manager to run the property. So let's assume, after paying all of your expenses, just to keep the numbers round, that you are left with $15,000 of profit at the end of the year. Now, remember what I told you in the beginning of this video. When you invest your money in real estate, this is considered passive income, which means your tax rates here are going to be the higher earned income tax rates. But you have the ability to lower your taxable income. So you made $15,000 of profit. And by profit, I'm going to talk about this is the cash that you have in your bank. But because this is passive income from your real estate, you have the ability to lower your taxable income, which is how much money you tell the IRS that you're going to pay taxes on. Let me show you. When you invest in real estate to rent out to other people, you get to qualify for what's called depreciation deduction. And what depreciation is, you get to tell the IRS, hey, my property is 1 year older, and so it has wear and tear. And because this property is 1 year older, I deserve a write-off. Even though I have money in the bank, even though that property might become more valuable, I still deserve a write-off because this property is 1 year older. That's what depreciation says. And then the IRS says, sure, you get to qualify for depreciation, and the base depreciation that you get to qualify for if it is a single family property like this is 127.5 of the value of the property. Remember, the value of the property is 200 grand, the value of the land is $50,000. This is the basic that you get to qualify for. I'll show you what that actually means. And just for those of you that are a little bit more financially nerdy, if it is a commercial property, you qualify for 139th. But because it's a single family property, what that means is you take $200,000, the value of the property, divide that by 27.5. That's how much of a deduction that you get for the next 27 years. That means you made $15,000. That's what's in the bank. And then you could tell the IRS, I deserve a $7,200 depreciation write-off. It's a paper write-off because it's not actually money leaving. It's just on paper, which means your taxable income here is $7,800. You're only going to pay taxes on $7,800, even though you have $15,000 in the bank. And again, the tax rate that you're going to pay is that higher earned income tax rates. But this is just the beginning. If you have a more savvy accountant, a more savvy financial accounting team, now you can even reduce this further. Take a look. So same example as before, $250,000 property, rent it out for $2,500 a month, $30,000 a year of income, minus $15,000 in expenses, you have $15,000 of profit. That's how much money is in your bank account. Well, what some accounting teams can do is they can do what's called accelerated depreciation. So we know that the IRS gives you this 127.5 depreciation. It's called straight line depreciation when you invest in a single family property. But if you have a savvy accountant, what they can tell the IRS is, hey, some of the wear and tear on certain parts of this property are going to accelerate, meaning you're going to have more depreciation in the early years. So in that first year of us buying this property, we should qualify for a 20% depreciation on the value of the property. So the value of the property is, again, $200,000. The land is $50,000. You do not get to depreciate the value of the land. So $200,000 property, 10% of that is $20,000. So now you have $15,000 of profit and you take a $20,000 write-off. This is depreciation. And now you have a $5,000 loss. Again, it's not an actual loss. You have $15,000 in the bank, but now your taxable income is negative $5,000. What that means in practicality is you're going to pay $0 in taxes even though you made $15,000 in profits. And then what you get to do is you have a couple options. Number one is you can take this $5,000 loss and carry it forward to next year's profits that you make from this property. Or let's say you work a job. You're making that $50,000 a year job. Well, according to the IRS, if you have a loss on your passive income, you cannot use this to offset this unless you fit into one of the exemptions. And the exemption number one is if you make under $100,000 a year, well, then you can take up to a $25,000 loss against your income. So here you made $15,000 of profit. That's how much is in your bank account. You take a $20,000 write-off, again, just on paper, so you have a $5,000 loss, which means now you get to reduce your job income because you're making under $100,000 a year to now $45,000 a year. That's what you're going to pay taxes on. You made 50 grand, you're going to pay taxes on $45,000, and then you made an additional $15,000 here that you're going to pay $0 in taxes on. Well, we can kick it up another notch from here too. Same situation, you bought this property for $250,000 and now you're renting it out, you're making money and you're paying less money in taxes because of this depreciation deduction. And now let's assume that you bought this property in a great area and now it is worth $500,000, and now you go to sell this property for a big profit. You made $250,000 of profit. You've been making rental income all these years and paying less money in taxes. Well, now that you've sold this property, you have to pay taxes, right? And we've already looked at the capital gains taxes, that 0%, the 15%, the 20%, and you made $250,000. That's a big profit, a big gain, except you don't have to pay it with real estate. Because in real estate, you can qualify for something called the 1031 like-kind exchange, which says if you take this property and sell it for a profit, in this case $500,000, you can take all this new money, all this $500,000, go out and buy another property. It can be bigger, nicer, more rental income, and now you can pay $0 in taxes on that appreciation, on that gain. And now that you bought a new property for $500,000, you can generate more rental income and have bigger depreciation because the value of the property is probably more as well. And you can do that again and again and again and never have to pay a penny in taxes as you flip these properties into more valuable properties. And you can do this until you die and never have to pay a penny in this capital gains tax. This is a game that wealthy people play to compound their wealth tax-free. They buy properties, they generate rental income, pay less money in taxes legally, then they work to see the value of the property appreciate, then they sell the property for a big profit, and then use that profit to buy another bigger property. That way you don't have to pay any taxes, which then creates that opportunity to generate more rental income. And you can do that again and again and again, assuming you hold each property for longer than a year and a day. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.